Hey folks, and welcome back to the Mortgage Farmer here at Mortgage Farmer World Headquarters in Cary, North Carolina. There's a topic that's out there right now that I want to spend some time with you on today. Have you heard this thing that's been mentioned by maybe somebody you've heard of, talking about the 50-year mortgage being possibly the solution to mortgage affordability and maybe getting first-time home buyers back in the market and things like that? I don't know, maybe you've heard of it, maybe you haven't. It's been a popular topic where we've seen quite a few people talking about it recently. Let's take just a minute and dig into this concept and let's find out, does it really do what President Trump is alluding that it might do? Spoiler alert, it ain't what you think. So for the last 50 plus years, ever since the time where Fannie Mae and Freddie Mac have really become a thing, the most popular, most common, most originated loan program was the 30-year fixed rate mortgage. The idea being that a term of 30 years was sufficient to help the average consumer come in, be able to afford the payments on the median priced homes at that time. Well, times have changed. Interest rates have gone up and down and then gone back up again. The price of homes has gone up over time. So we're running into this scenario where we're trying to find out if there's something else out there that might be beneficial to consumers. So the topic was 50-year mortgages. Instead of a 30-year, we make it a 50-year, adding 20 years to the term. Wouldn't that be the solution? Wouldn't that help us get where we need to get as far as affordability? Well, come along with us here and we're going to dig into that. We're going to talk numbers and show you so that you can see for yourself. Oh, hey, I was just dreaming of back when times were good, when rates were low and houses were affordable. Oh gosh, it hasn't been that long ago when we were looking at mortgage rates below 3% for 30-year fixed rate mortgages. Now, I don't think that we're going to go back to that point. I don't believe we're going to be with rates that low, but I don't think we need to either. Let's talk a little bit about history. So over time, the last 80 to 100 years, if someone had an interest rate on a 30-year fixed rate mortgage of 6%, it would have been viewed as fairly reasonable, fairly stable. We had some times in the 70s and 80s when rates were really high. We had some times in 2020, 2021, and some other times too, but during that time period when rates were really, really low. And affordability, or as measured by the affordability index, which is a function of earnings of consumer compared to the cost of houses and the cost of funds, interest rates, and all those things dumped into a soup and stirred up. And what came out was called an affordability index. And it hasn't been that long ago when the affordability index was at its highest point, meaning affordability was higher than it had ever been at any point other than the Great Depression. Well, we don't want to go back there. But there's a lot going on there. 30-year fixed has been the benchmark for lending purposes for 60 years, maybe longer than that. There are other options, 10-year, 15, 20. Those are programs that are out there and available, but the 30-year has been the stalwart, if you will. That's been the thing that we've used the most of. So now, President Trump has sent up a test balloon, if we think that's what it was, talking that he believes that the 50-year fixed rate mortgage is the answer. Well, I'm going to tell you in this next video right here to follow why that's not really the case. It's fool's gold, if you will. It doesn't do what everyone might think it would do. But before we do that, we've got to actually talk about some of the factors involved in why it's probably not what President Trump envisions that it might be, and some of the legal reasoning behind it. Let's talk about that now. So you may remember on the heels of the financial crisis that we had in the mid-2000s, 2006, 7, 8, in that range, where we had a market implosion and banks were going belly up left and right, foreclosures were skyrocketing, it was out of control. And part of the reasoning behind that was because we had out of control mortgage loan programs and products that probably should have never been invented, but yet they were. So, as a result, the Dodd-Frank Financial Reform Act of 2010, which became enacted in 2011, put some guardrails in place to protect the mortgage industry, among other things, but to protect it a little bit. So during that period of time, they created a phrase called the qualified mortgage. And basically what it meant was if you met the narrow definition of a qualified mortgage, then you as a lender had lots of protections against things going on with foreclosures and people suing you down the road. You had what was called safe harbor if you fit inside that box. Well, the biggest piece of that box revolved around the fact that to be a qualified mortgage, you had to be a 30-year mortgage. So if you were going to do a 40-year mortgage, which existed, or a 30-year interest only, which existed, they would not be categorized as a qualified mortgage. If they're not qualified mortgage, that means they are a non-qualified mortgage, and then created a cottage industry called non-QM. Now, it wasn't the subprime industry, but it operated in a similar fashion to the subprime industry in that you had unique programs and products that were being offered, but they were not qualified mortgages because they weren't 30-year. So they were called non-QM. And as you might imagine, any non-QM carried with it a higher interest rate. Here's where the fly is in the ointment for this concept of a 50-year mortgage. Unless someone can repeal and or amend the Dodd-Frank Financial Reform Act of 2010, and trust me, there is not any motivation and there is no movement towards doing that. Unless they do that, 50-year mortgage, anybody that wants to create that particular product, by the way, anybody that wants to do it right now can do it if they wish to. It's just a non-qualified mortgage, which carries with it a higher interest rate. So, how does that relate, the interest rate on a non-QM loan, 50-year fixed rate mortgage, as it relates to where we are now on a 30-year fixed rate mortgage? Let's talk about that, because I think that's really the crux of this argument. You need to understand that if you create a new program that's a 50-year fixed rate, it's non-QM, and it will always fall in the non-QM bucket and carry with it non-QM rates. Let's see how that matters. So as we're comparing and contrasting non-QM with the standard 30-year fixed, let's talk a little bit about some of the qualifiers, if you will. So let's take into account, for instance, right now, the average Fannie Mae 30-year fixed rate mortgage interest rate across the nation, is 6.3. Now, remember for a moment, interest rates are offered in 1/8% increments, so we're going to talk about 6.375. That's the closest to 6.3. 6 3/8 is what we're talking about. Now, let's take a median home price. So the median home prices now are right around $500,000. I'm using general math, so humor me as I kind of do that. But let's say a $500,000 house. Now let's say you're going to put 20% down for a loan of $400,000. You don't have to put 20% down. It could be a sales price of $450,000 and a 10% down, or $50,000 down, if you will, for $400,000. But those are the things that I'm using. I'm starting with a current 30-year fixed rate of 6 3/8, and I'm looking at a 30-year fixed at $400,000. The monthly payment on that is $2,495, principal and interest. So you need to add taxes and insurance. But anyway, $2,495. Okay, remember, I already told you that the 30-year interest-only mortgage already exists. But because it's not a 30-year fixed, it's a non-QM. Non-QM means immediately that you're going to have a higher interest rate. So the 30-year interest only, let's just say the interest rate is 7%. It might be a little bit more than that, it might be fractionally lower, but I think 7% is a good round number. An interest-only payment on that same $400,000 would be $23.33 a month. So you save $160, something like that, by doing interest only. But one of the reasons that interest only did not gain qualified mortgage status was because of the potential for negative equity. If you buy a house and you never pay down on the principal, there's always the fear that you may end up in a negative equity situation. And that's one of the reasons that we got into the crisis that we got into in 07 and 08. We had these loans called negative amortization loans. Now, they were done away with, but the idea remains the same. Anyway, 30-year interest only, maybe let's say 7%. Okay, now let's talk about this 50-year fixed rate mortgage that has been floated. Okay, first and foremost, it will be a non-qualified mortgage, non-QM. It's going to carry a higher interest rate. Think about it this way. A 15-year fixed rate is a higher rate of interest than a 10-year. A 20-year is higher than a 15. A 30 is higher than a 20. So a 50 is definitely going to be higher than a 30. And add on top of that it's non-QM, and it is likely that you would be looking at an interest rate on that 50-year mortgage of probably 7 3/8%. Okay? And you're saying, well, David, you just cherry picked. Well, follow me on this. So 7 3/8 carries us to a principal and interest of 25.22. The payment is higher than the 30-year fixed rate at today's prevailing rate. Okay, I hear you. I know what you're going to say. Put it in the comments. That's fine. I'm totally fine with that. You're saying I'm cherry picking and that I chose an interest rate too high to prove a point. Okay, fine. Let's say it's only 0.5% higher. And I can assure you, I've been doing this 35 years and I am familiar with non-QM loans. A non-QM loan is going to have an interest rate at least 0.5% higher than the conforming fixed rate that it's tied to. It just is. It's just going to happen. That's just the market right now. And it may be more than that, but let's just say it's a half higher at 6 7/8. Okay, 50-year fixed rate mortgage at 6 7/8 is $23.68. Okay, we've now dropped the monthly payment. What's that? $130, not quite $130 a month from the 30 versus the 50. So, I mean, at least theoretically, it's accurate to say that the monthly payment's going to go down. But it doesn't have to be that way. And here's why. If we can just get the Federal Reserve and Mr. Powell and his group to accept the fact that inflation should not be the only number that they're looking at before they're willing to lower the federal funds rate, which in essence pushes everything down a notch. The 10-year T-bills come down, prime rate comes down, auto loans come down, credit cards come down, mortgage rates all come down, generally speaking, if they were to drop it. So let's say, remember, 5 years ago, we were under 3%. And we're not going back there. But let's just say interest rates drop 1% from 6 3/8 to 5 3/8. That's reasonable. And that's actually within the power of the Federal Reserve to drop it so that mortgage rates would be, on average, 5 3/8 instead of 6 3/8. And in that example, the monthly payment on a 30-year fix would be $22.39 a month. That's even lower than the 50-year. Okay, so you see my point. What I'm trying to say here is we don't need a new loan program. We don't need a 50-year fixed rate mortgage. We just need Powell and his group to see what we've all already seen with the damage that has been done to the economy on everything except inflation. Of course, we got inflation down. Yay, we got inflation down, but we killed everything else in the process. That's like rounduping your entire yard because there's one weed in the yard, and by God, you killed the weed, but you killed everything else as well. We need to look at this with a little bit bigger picture. And if we could see interest rates fall a reasonable 1%, by the way, that is not unheard of. We have already dropped roughly 1%, 0.75%, something like that, depending upon what time periods you look at, in average 30-year fixed rates over the last year. It's not impossible. And 5 3/8, it's not like we've never seen it before. We spent 4 years at 3% or below. So 5 3/8 is not that big of a deal. But it gets us what we needed to do. We don't need a 50-year fixed rate mortgage. We don't. We just need interest rates on mortgages to be more conducive for the average homeowner or potential homeowner to be able to afford it. Sorry about getting on my soapbox. I apologize for that. I hope you've enjoyed this video. Please hit that subscribe button, hit the like button. Give me a comment. Tell me what you think. Am I way off base? Be nice, because as I've said in many of my videos, don't take me that seriously, because I don't take myself that seriously. Truthfully, leave a comment. Tell me what you think. React to what I've said. If you believe my numbers are wrong and you can back it up, tell me why my numbers are wrong. I will have an intelligent dialogue with anyone that wishes to have it, with the caveat being it's an intelligent dialogue and it's based on facts, and you can back those things up. Let's talk about it if that's something you want to talk about. We don't need a 50-year fixed rate mortgage. We just need 30-year fixed rate mortgages, the interest rates to go back to a reasonable number. Don't get me started on the fact that the United States is partial owners in Fannie Mae and Freddie Mac, and there's a whole nother conversation to be had there. Maybe we'll have a video one day about these things called LLPAs, loan level price adjusters, and how those have gotten out of whack over the last 5 to 7 years. If any of you watching this video have tried to purchase either an investment property or a vacation home in the last 7 or 8 years, you know what I'm talking about. The things that got you were the loan level price adjusters that kept going up and up and up on those products because Fannie Mae and Freddie Mac needed to create a little bit greater rate of return. That's a whole nother topic for another day. I appreciate you spending a few minutes with me. I hope you've enjoyed this video, and I hope you'll come right back here and see me again at the Mortgage Farmer.